Hi, my name is Marcy Berger, and I'm the Member Services Coordinator here at APSA. Welcome to Are You Prepared for What Is to Come on Product Cancellations? This presentation is a part of APSA's Business Partner Webinar Series, which is industry experts to share timely educational topics directly with APSA members. The webinars are designed to provide information that allow APSA members to more effectively design, develop, and implement strategies for their company's success. A few housekeeping notes. To ask a question, use the question box on the side of your screen. I'll read them aloud to all following the presentation. The slides and recording of today's webinar will be available on APSA's website in the Webinar Resource Center. Finally, you'll receive a survey after the webinar is over. Please take a moment to complete it. Your responses help us fine-tune the program so we can target the issues that are important to you. Now to our presenters. John Elias has been a Senior Director of Lender Sales at Cox Automotive for nearly 7 years. He brings more than 25 years of accumulated knowledge and experience in the auto finance industry, having worked across the automotive finance spectrum in OEM, captive finance institutions, and banks, including key leadership roles at Equifax and LexisNexis. John is a certified fraud examiner and has led roundtable discussions on emerging fraud risks and prevention strategies to enable frictionless credit evaluation. Our other presenter, Kenneth Royce, is a managing partner of Neeson & Elliott Automotive Finance Group, one of the nation's leading auto finance legal practices. Mr. Royce has been actively involved with federal and state regulators, including matters with the Consumer Financial Protection Bureau. On to the auto finance front. He is a member of the legal committee of the Association of Consumer Motor Vehicle Lessors and a regular contributor to the American Bar Association publication, The Business Lawyer. And our other presenter, Kelly Rice, is an associate in Neeson & Elliott's Automotive Finance Group. She counsels a variety of clients, including banks, captive finance companies, and independent lenders in matters relating to motor vehicle, retail finance, lease, and loan transactions. Now I'll pass it over to you, John. Thank you.
Marcy, thank you. Let me see if I have the slides. Thank you. Thank you again to everyone joining us today. We truly appreciate your time and attention. So before I kick off into a few of the numbers here that I have on the slide, I'm certain most of you are familiar with F&I Express and Cox Automotive, but for a quick recap, F&I Express started in 2008, building connections with aftermarket providers, and became a wholly owned subsidiary of Cox Automotive in 2018. The intention of that acquisition was to take those integration points and really link those into our larger networks of over 22,000 dealerships and 1,600 lenders. Now, starting with a cloud level view of the aftermarket product industry, let's start speaking to a few of the data points that you see on the slide today. There are more than 500 aftermarket product providers in the space today. It's a very lucrative business. As such, you can tell that by the VSC industry alone was valued at $35 billion in 2018. On average, through our platform, we see 2 aftermarket products are part of the final deal, with a consumer cost of around $2,500 on average. Again, taking a look in our system, about 75% of those products are gap because we're performing. 75% of our cancellations are gap related, and 17% with the remaining 8% spread over other product lines. We see on average, the refund of these cancellations is $433.08. Furthermore, our data is showing cancellation refunds may amount to an industry of $4 billion or outstandings. However, we do believe it may be higher. And really one of the last stats, or one of the last things to bring to mind is, we're looking at approximately 2.4 million repossessions in 2019. That's a lot of cancellation volume and just in one part of the business. We're also expecting that those forecasts or those repossessions and the forecasts are indicating that it will accelerate in 2021. So kind of a summarization, managing the cancellations is a large task. There's multiple departments that are performing it based upon how the early termination occurred. So I'll advance into the next slide. So again, it's difficult to track the multiple cancellation processes, through the multiple departments, but compounding that is the fact that you must be aware of the state regulatory mandates. So this is a good time to switch over to Ken and Kelly from our partners at Neeson and Elliott. But before I do, please participate in the following survey so that we can better understand where you are at today. So I'll give it a minute here as the results come in. So on the first poll result, the question being, do you believe you're responsible to ensure aftermarket refund to the consumer in the event of early loan payoff? We're seeing a 79% saying yes, which is similar. Then that's very much aligned with what we're hearing with our partners today. I don't see the results for the second one. Perhaps they're still coming up. Those are some interesting numbers. We've heard a little bit. It's been a mixed bag of results when we've worked with our partners in the past. So I didn't expect much less here, except maybe a little bit surprising on the none. But I'll let that wrap up. And Marcy, if you could turn over the controls to Ken and Kelly so that they can begin their part of the presentation.
Well, thank you very much, John. This is Ken Royce. As John and Marcy mentioned, I'm the managing partner of the Auto Finance Group in Chicago, Illinois, and we're delighted to partner with Cox for this presentation on ancillary products this afternoon. And just by way of background, our practice group, our forte is exclusively focused on auto finance. So we've had the opportunity over the last several years to extensively review the ancillary product regulatory domain at the state law level. And one thing I should mention in this pandemic era, I think it's of particular importance that everyone be mindful of the fact that in this pandemic era, consumers are really counting on getting refunds if they are, if they are in fact due them. So with further ado, I think what we're going to do this afternoon, we're going to be taking a look at the regulatory and legal background with respect to refunds on gap waivers, service contracts, and credit life policies. And in that regard, there will be 5 critical issues that we'll be looking at for our review. The starting point of the review would be the actual contract itself, whether it's the gap contract, the vehicle service contract, or the credit life insurance policy. That starts the process. What do the 4 corners of that document say? And then we have to overlay the next level, which is the critical state law environment. Notice that I'm not mentioning federal law because most of the activity here resides at the state law level. In that state law level process, we'll be talking about the party that's responsible for the refund, and that could either be the creditor or lender. It could be the provider, the service provider, the gap provider. It could be an administrator or an insurer. Then we'll also look at the timing issues, another critical element in analyzing ancillary products. Are there certain time constraints in terms of providing the refund or when the refunds have to be made? And lastly, we'll delve into the calculation methodology. So let's first of all start off with a brief introduction of our first of 3 product arenas here, and that would be the introduction to gap refunds. Now, many of you on the call are probably aware of going back 15 to 20 years ago, there was a threshold question of whether or not gap is even considered insurance or non-insurance. But by and large, that issue has been resolved, and virtually every state recognizes a form of gap waiver as a non-insurance product. And we'll talk about that later in the presentation. There's some unique exceptions. So with the assumption that this is a non-insurance product and that the gap waiver we're talking about is that the contractual waiver that allows a payment to cover the difference or so-called gap between the total loss proceeds in the event of early termination and the early termination liability derived under your lease, loan, or retail installment contract. Now, as you'll see, a majority of states will require a refund in the event of a cancellation. We have determined through our extensive research there are at least 10 that impose an affirmative duty on the lender or the creditor to provide the refund, but there are some nuances that Kelly and I will be talking about in a moment. The typical refund calculation will be based on a pro rata portion after the expiration of a free look period. So what we'd like to do for not only gap, but for each one of the products, we're going to be giving you state law samples in each area. And Kelly, we're going to be looking at Colorado, New Jersey, and Texas for gap refunds. So Kelly, do you want to start with Colorado, please?
Sure. So we begin with Colorado, where the creditor is the sole party responsible for providing the gap waiver refund. In other states, there may be a situation where the creditor may have to cause another party to provide the refund, but we'll discuss examples of that kind of situation in the next couple slides. But at the end of the day, the creditor is still responsible for providing the refund in Colorado. So when does the creditor have to provide the refund? It depends on the free look period. In Colorado, there's a 30-day free look period, and most states have 30-day free look periods, but it can vary. If the borrower cancels within that free look period, he or she is entitled to a full refund as long as there is no loss. But what if the gap waiver contract is canceled after the free look period? In Colorado, the borrower is entitled to any unearned portion of the purchase price as specified in the gap contract. And that shows the importance of looking at the terms of the gap waiver contract itself. Moving on to New Jersey. In New Jersey, the creditor must provide the refund or cause the administrator or retail seller to provide one.
So Kelly, what does that mean?
Oh, yeah.
Yeah, what does that mean? They have to cause the administrator or retail seller.
Sure. It means the creditor is responsible for ensuring that the administrator or retail seller makes the refund. So the creditor may have to contact the administrator or retail seller and then perhaps continue to follow up until that refund is provided to the borrower.
So at the end of the day, in New Jersey, the creditor is ultimately responsible, but they also could involve the administrator or retail seller to provide the refund, but they have to ensure that the refund is made.
Right.
Is that correct?
Yes. Yep. And then New Jersey, like Colorado and most of the other states, as we mentioned, has a 30-day free look period, and refunds must be provided within 60 days of the event terminating the finance agreement or within 60 days of the receipt of the borrower's cancellation of the gap waiver. So if the borrower cancels within that 30-day free look period, they're entitled to a full refund. If the borrower cancels after the free look period, he or she is entitled to a pro rata refund of the purchase price, less any cancellation fees not to exceed $50.
Well, that's interesting. They could, so a lender could charge a cancellation fee in New Jersey.
Yes.
And is that something that that have you seen statewide, or how pervasive is the ability to charge cancellation fees?
So we've actually taken a look at this recently on a 50-state basis, and only a handful of states, including New Jersey, expressly authorize gap waiver cancellation fees.
Okay, very interesting to know. Thanks for sharing that, Kelly.
Mm-hmm. Yep. And then finally, we have Texas, where the creditor or administrator is responsible for the refund. Texas falls into that majority of states with a 30-day free look period. If the borrower cancels within the free look period, the borrower should receive a full refund. If total loss or theft has not occurred, after the free look period, the calculation methodology is dictated by the terms of the contract. We see the typical refund calculation for cancellation after the free look period is a pro rata refund. But again, it's very important to look at the terms of the gap waiver contract itself to determine the refund methodology in Texas.
Kelly, let's talk a little further about the importance of that gap contract itself. I talked to you earlier about, that's the starting point for our regulatory legal analysis of the due diligence involved here. But tell us more about the types of gap contracts that you've seen out there in the marketplace. What are you seeing in terms of the contracts we're reviewing for compliance?
Right. We see two types of forms. The first being a generic form that can be used for multiple states. So that form will include state law notices and carve-outs for things like timing, calculation methodology, and cancellation fees. We also see state-specific contracts. So you could have a state-specific gap waiver contract for Virginia, for example, and that document form will include specific disclosures or notices that are required by Virginia law.
Okay, well that's very helpful to know. Couple other things while we're still in the gap domain. What we have seen primarily is the gap product finance in the context of retail installment sale transactions. And one of the reasons why you don't see it too pervasive in the leasing domain is that most major lessors have built in or embedded a gap provision. So if you're selling or financing a gap that's in a major lease, that could be a problem. That could be a red flag because there's really no need to do so. That's just a note for those in the audience that might be, have a built-in lease program. We also do have some clients that are looking at the issue of extracting the gap, the built-in gap, so the dealers would have an opportunity to finance. But that's going to be on a client-by-client basis. Another issue that's worth noting here with respect to gap contracts is that, again, I referred to that by and large gap waivers that we have seen are non-insurance products. But if you start adding on certain bells and whistles, and there are gap plus contracts or gap enhancements, and you attach a cash payment or other monetary benefits above and beyond the total loss coverage, if you will, then that non-insurance gap contract could transcend into the insurance domain. And guess what? Then at that point, you're probably talking about a whole different regulatory domain or environment because you're looking at gap as an insurance product. So that's just one point to remember that if you're looking at gap with certain enhancements, it could trigger a recharacterization or reclassification. One last point on gap, Kelly. Let me ask you this question. What if the gap contract itself doesn't comply with state law?
Well, you could be in big trouble because even though you didn't draft the contract, if you're following non-compliant provisions and are involved with the process of providing a refund, then you could be liable for non-compliance. So state law will control over a deficient contract, and that just underscores the importance of understanding and following the parameters of state law. So if you have any doubt about whether your contracts are state law compliant, you should seek legal counsel. And if you know that a contract is inconsistent with state law requirements, then you should make sure you're not financing non-compliant contracts.
Well, that's an excellent point. That's an excellent compliance point. All right, well, why don't we move on to the service contract arena. Kelly, let's start off with your first state there. Actually, I'm sorry, let me give you a little introduction before you go into the states of Arizona, Florida, and North Carolina. In this arena, I think we're looking at primarily, again, non-insurance products. We've identified at least 23 states where the service contract provider has the initial or primary obligation to provide the refund. There may be a handful of states that require the insurer to provide the refund, and that could be cases where the service provider didn't provide the initial refund. And Kelly will get into the typical parameters of the timing and the calculation of refund. So let's delve into then Arizona, Kelly.
Sure. So the applicable Arizona statute says that a refund must be provided, but it does not obligate a specific party to provide that refund. It's not expressly stated in the statute, but we would say if a dealer or finance company knows that a contract is being terminated early, that should trigger the process of notifying the service contract provider so that a refund can be given. The statute also does not provide any specific time frames, but it does state, as far as calculation for the appropriate refund, that the borrower is entitled to a pro rata refund after deduction for benefits paid and administrative expenses associated with the cancellation. Moving on to Florida. Now looking at Florida, we want to note that Florida is actually one of the most heavily regulated states regarding service contracts. Florida expressly obligates the service contract provider to provide the refund. Florida law also provides a time frame that dictates the appropriate refund calculation. The statute says that any service agreement is cancelable by the purchaser within 60 days of purchase. If the contract is canceled within that 60-day period, the purchaser is entitled to 100% of the gross premium paid less any claims. And then after that 60-day period, if cancellation occurs, then the statute says the purchaser is entitled to not less than 90% of the unearned pro rata premium less any claims. And moving on to North Carolina, the statute does not expressly provide the specific party that is responsible for the service contract refund, so we would reiterate the comment I made on the Arizona slide that it would be prudent to notify the service contract provider if the contract is going to be terminated early so that a refund can be given. The North Carolina statute does say that the consumer can cancel the contract at any time after the purchase, and the calculation methodology for that refund is a pro rata refund, less any claims paid, less a reasonable administrative fee not to exceed 10%. So there is a cap to be aware of on the administrative fees that may be deducted from a refund in North Carolina.
So Kelly, let me answer this question. Okay, and this would, could apply to North Carolina, Florida, Arizona, or for any state in connection with service contracts. What happens if the service provider is no longer there? They filed bankruptcy, they liquidated. What goes on? What can the consumer seek redress? What happens?
So the purchaser could go after the service contract provider in the event of bankruptcy, but the likelihood of recovery is pretty remote.
Mm-hmm. So one of the things I wanted to mention here is that there have been some live cases where national warranty companies did go belly up, and dealers and banks and captive finance companies were kind of left holding or left in the dark, so to speak. So in those cases, as Kelly mentioned, a consumer could attempt to pursue some type of claim, but as she mentioned, it's the likelihood of recovery is remote. But hopefully we don't see that too much in the future, but that is a possible scenario, and it has happened. It's just something that you need to be aware of, and maybe also something that you need to, as a lender finance company, credit union, or specialty finance company, determine which service contracts you want to finance. So Kelly, let's wrap things up with a quick review of the credit life arena.
Sure. So all 50 states place an obligation on the credit life insurer to provide the refund. And then we have just very brief summaries for California, Massachusetts, and Ohio. In California, the applicable statute says the refund is due promptly to the insured. The formula used in calculating the refund must be filed with and approved by the California Insurance Commissioner. In Massachusetts, no specific timeframes regarding credit life insurance refunds are given in the statute, but it would be prudent to provide the refund as promptly as possible. And the statute says the refund of any unearned charges for life insurance must be computed on a method which is at least as favorable to the borrower as the actuarial method. And finally, Ohio handles credit life insurance refunds in the same manner as California.
Okay, great. One thing, and now that we've gone through all three of these products, it may be also interesting to note here that, for example, with credit life, it's insurance, and it's predicated off the individual involved that's getting the insurance. On the motor vehicle service contract, it's vehicle centric. It's focused on the vehicle. And in the gap product arena, it's tied to the contract and the liability of the individual borrower, lessee, or retail buyer. Okay, well, with that in mind, let's take a look at then the next topic here with respect to ancillary products. And that is the compliance risks. Obviously, we've laid out, an overview of state law primarily, but I think every lender, finance company, credit union needs to be acutely aware of the fact that there are risks out there for noncompliance, and they could reside with individual harmed consumers filing individual actions. They could mushroom into class actions at a statewide level or a nationwide class action, or most recently, as evidenced by some of the major settlements over the last 2 or 3 years, some of them involving top 5 or top 10 auto finance companies, there have been major regulatory settlements involving the handling of gap refunds. So we know for certain that the CFPB, the OCC, the FDIC, as well as state AGs and state banking departments are very carefully monitoring and regulating this. And indeed, by virtue of these rather high-profile settlements, we know these risks are for real. In addition, as we speak today in December 2020, we know that they're on the examination screens of the federal regulators and the state regulators. They'll want to know how you are managing your refund process, whether you're doing it internally or a combination of service providers. So to wrap up on the regulatory side, again, it's just important to remember that the first step is to understand the contract terms of the ancillary product that you're financing, because those will dictate the state law issues. They have to be reviewed against state law, as well as looking at the timing classification and the calculation methodology. So John, I'm going to hand it back to you for maybe the updated poll question.
Oh, shucks. I apologize, everyone. I was on mute. So thank you for notifying me, Len. Yeah, we had two more poll questions. They've already started, so please participate in those. And as soon as those results come in, I'll go ahead and kick off into the next portion of the presentation. Yeah, pretty much aligns with what we've seen. So again, thank you for participating. Once we get back to the presentation, I'll go ahead and kick back off. So that was some great information. Both Ken and Kelly, thank you again. Drilling into the individual states. One thing that we do here at Cox is we hold regular roundtable conversations and discussions with our partners. And overwhelmingly, the consensus is that the CFPB will become more active as we see more of a consumer-focused administration coming in to take office. So, what can you do and how can you protect your investments? So just walking through the boxes from left to right. Market transparency across all of the stakeholders. That means that the lenders communicating with the dealerships communicating with the providers, and full circle in the communication. Collaboration and data sharing. So as we're approaching this, it's very much, we all have a mutual priorities and individual priorities. So 2 out of the 4 parties are the only ones that are initially aware of an early termination. So if you think about collaboration and data sharing, the only 2 parties that know about the initial early termination of the loan would be the consumer and the servicer. That requires further communication to the dealer so that they're aware, as well as the cancellation notification to the provider. The consumer focus. We should be laser focused on the consumer and what they need, effectuating the refunds as quickly and as accurately as possible. Engaging in constructive conversation with regulators. And then last, but certainly not least, are the technology upgrades that can make all of these processes faster and more efficient. And a consolidated system of record or platform that provides immediate information. So for example, copies of the notifications, timestamps of when they were sent, accurate refund data, and a log of the communications tracing the funds from the provider to the dealer, to the lender, to the consumer. I'll move on to the next slide. So breaking down the loan life cycle, where can we implement these control points to effectively manage the aftermarket product cancellation requirements? It starts off with the consumer in the origination piece. The consumers are out there searching for cars, entering into a purchase engagement. A quick note on that, we're seeing more and more of these consumers entering the process digitally. And interestingly enough, some of the observations we've made on that is that they're actually purchasing more products when they're enabled to review the products and kind of orientate them to their needs before they walk into the dealership. So it's actually a positive sign for the dealership. It's enhancing the profitability of those particular purchases. Once funded, so that the consumer's gone through the process, they've entered into the dealership, they've engaged in the contracting, the dealers really no longer have, nor do they really want visibility into the loan servicing. So historically, when the loans are terminated early, the general position in the industry was the dealer should be the center of the aftermarket cancellation process. This creates inefficiencies given their lack of visibility and faith on behalf of the lenders that the dealer will follow through on the cancellation and effectuate the payment to the consumer. Additionally, if the lender is asked during the examination to provide proof that the funds can be traced back to the consumer, historically, we require contacting the dealership to provide the evidence. As we all know, some dealerships are good at record keeping, some not so much. But one thing we know about the dealerships from experience, they have a distaste for paperwork and chargebacks. Compounding that issue, though, at the dealership level is the fact that we're seeing the dealerships consolidate. Some are even closing, and you may elect to stop doing business with certain dealerships. So all of those factors together threaten the availability of information. So it's a very time-consuming and labor-intensive process with multiple failure points and way too many places where data and refund monies can leak. So let's move into each one of these topics individually. I'll give it a second. There's a bit of lag, so I don't want to go too quickly. One of the most important things we can do is to only fund, or one of the most important things for you to do is to only fund aftermarket purchases from approved providers using approved forms. From there, the process should include capturing the product information as quickly upstream as possible. As most of you are familiar on the phone, during an early termination due to early payoff, the major hurdle is to grab the data so that you have the appropriate data to fill in for the cancellation. So the ability to grab that up front, obviously, is an efficiency on the back end. You'll want to establish ongoing review of aftermarket advance policies, and that's something that we see frequently happening today. So I think most of that's underway. And then to continually monitor the dealership behavior with respect to aftermarket products. And one example, that's pricing. But I think another example is to ensure that the policies are being submitted to the providers. Over the last 12 years that we've been doing this and processing cancellations, we regularly see a small percentage of policies that are not filed with the providers, which begs the question of why is that? It could be a simple oversight, or it could be a signal that there's cash flow issues within the dealership. At the end of this, every lender should assess their operations and ensure that a version of these controls for aftermarket product management are in place. I move to servicing. So as we recommend recommend controls for you to establish on a cancellations process, in servicing, it's looking at the electronic filing of cancellation requests to dealerships and providers. So for example, the system that we built notifies both parties simultaneously and keeps copies of those notifications with timestamps. Ongoing monitoring of those cancellation refunds owed. This is important because many of the consumer protection laws around aftermarket product cancellations establish a time frame, which is something we just heard from both Ken and Kelly. And then using exact cancellation refund amounts to manage refunds. I'll expand on this just a little bit more. The only party that knows if a policy is in place, active, and if the exact refund amount is the provider. The service that we provide is to gather that information directly from the provider system. So accurate refunds are critical to, number one, avoid dealer friction on reserve settlement statements. Two, to avoid over refunding. What I mean is for VSCs, for example, are subject to claim. Therefore, if a claim is filed, it may eliminate any refunds due. Again, that's a lot to take in. You may not be able to do all of these things at one time, but staging to go ahead and implement those controls will be beneficial to long-term management. Three, then take a look at loss management. We have three key things that you can do to ensure timely receipt of aftermarket cancellation refunds. The first is simply follow up with dealers with respect to the cancellation refunds at certain points after the cancellation has been filed. We provide additional follow-up letters. That's just something that we do. And we also have partnered with Allied Solutions, and they offer an enhanced follow-up. This may not apply to everyone, but for it does, if necessary, move toward using dealer reserve statements. Their vehicle that we've seen lenders use is they do go after the reserve statement to recapture funds. And again, placing that one is back on the dealer so that they can ensure that the cancellation and whatever refunds are due to them from the provider is their onus. And it may be helpful to provide tools to dealerships to assist them with their collection efforts from providers. Again, as I mentioned earlier, we simultaneously reach out to both the provider and the dealer. So the dealers really look upon that favorably because that portion of the paperwork that they would be held accountable for, or that function would reside in their court, we're already performing it for them. And many of our customers appreciate that fact, as when they go to remediate with the reserve statements, they know, the dealership knows that cancellation notice has already been served to the provider. So it's just basically a cash flow advantage that they. Moving into retention. And the final stage here is retention. And as a lender, the most helpful process you can implement would include getting real-time aftermarket cancellation refund quotes from dealerships. The importance of which was discussed earlier. I'm sorry, I meant for dealerships. Improving underwriting of new deals by applying refunds as additional down payment. So automating an accurate quote process into the loan payoff process. As you know, on the DT platform, we offer a payoff quote functionality used by dealerships during the desking period. We have seen some lenders embrace that, and they are actually applying refunds proactively to the payoff amount so that the consumer can use those funds on the purchase of a new car. And also consider modifying your current policies to allow dealerships to remit the payoff net of the cancellation refund. So that's just quickly walking through the loan life cycle. I'll move on to the next slide. Okay. So the good news is, as I mentioned just a second ago, we've seen many lenders have major initiatives underway today to help solve for some of these challenges that they face. They include some of the things that we've heard and the feedback that we've received, re-engineering current internal processes, deliver a faster and more accurate cancellation process that benefits the consumers and dealerships alike. This includes you as a lender needs to be an active part of educating dealerships and providers on their compliance and regulatory responsibilities. Automating the aftermarket product cancellation request process. So alleviating that paperwork burden on dealerships as much as possible. There are a few technology options in the market today that you can leverage, and they aren't expensive in comparison to the fines. So taking a look at these can help. Obtaining exact aftermarket product cancellation refund amounts to ensure consumer refunds and deficiency balances are accurate. Critically important for repos is that it improves the balance sheet management and accurate deficiency balance reporting to the credit bureaus. Moving toward dealership reserve chargeback rather than invoicing to obtain cancellation refunds. A positive trend we're seeing for lenders and consumers is that an increasing number of the aftermarket product providers are sending the full cancellation refund to the lender and charging back the selling dealership on their monthly statement. This both accelerates the refund process and reduces the administrative burden on the dealerships. So we have moved quickly to the Q&A. Thanks again for giving us time to present our thoughts on innovation and in today's industry. Now we're going to start addressing questions that you posted throughout the webinar. Marcy?
Thank you so much. The first question is, what if the administrator sends the refund to the dealer and the dealer is out of business?
Was that addressed to the lawyers, Marcy?
Always to the lawyers, Ken.
If they sent the refund to the dealer and the dealer's out of business, and if it's a state where the creditor must provide the refund or cause the refund to be made, then they have to take additional steps to make sure that the consumer, in fact, gets the refund. I mean, I think that's kind of the bottom line answer. So if the dealer is out of business, that doesn't exonerate you from liability. You still may have to, perform additional duties to make sure that the consumer at the end of the day gets the refund.
Great, thank you. Another question is, what if the creditor is unsuccessful in causing a gap waiver refund?
If the creditor is unsuccessful in causing the refund, again, Kelly, you're talking about the state. There's a number of states where they have to cause the administrator to provide the refund. In those states, if the refund is not being made by the administrator, ultimately the responsibility reverts back to the lender, because it's the lender or causing a third party to make the refund. So there again is kind of an implied duty of monitoring to make sure that the refund has in fact been made if they decide to delegate that refund function to the administrator or the dealer.
Thank you. Another question is, for Colorado, is it allowable for the administrator issue the refund on behalf of the creditor, or does it require the administrator to send the lender?
Well, and that's a good question. I think as long as the consumer gets the refund, I think that's the most important thing. But if, again, they involve a third party, you ought to make sure that the refund has, in fact, been made to the consumer.
Thank you. Another question is, what is the free look period?
Kelly, do you want to address that one?
Sure. So the free look period is the time frame that during which you have the option to cancel without penalty.
Great, thank you, Kelly.
So
Another
for Marcy, for a gap contract, that would be typically what, 30 days, Kelly?
Yes. Yep. Correct.
Okay. But it could be extended to 60 days.
Right. Right.
Thank you. What is the governing law for the creditor location or for the borrower residence?
Well, yeah, that's a very interesting question. And, typically a retail installment contract or a lease will be governed by the state where the dealer resides. And, in most cases, the lessee or the retail installment sale purchaser and the dealer are located in the same state. But keep in mind that the ancillary product is a separate and distinct contract. And, by its own terms, it will typically cover or comply with the law of the state where the purchaser of the contract is located. So, for example, you have a dealership in Colorado, but a Kansas resident is coming into Colorado for the transaction. They'll want to make sure that the contract is compliant with the law of the residence of the buyer, which is Kansas, because that state would afford that party consumer protection. And as Kelly mentioned, if they're using a national or generic type of gap waiver contract, for example, they would have all of the state disclosures and notices covered. So if there were Kansas unique disclosures, it would be covered in the contract. But the bottom line is you have to take into account, and the contract should be driven off where the customer resides and cover those obligations.
Thank you. Are paid off loans the only type that are these provisions apply to?
Well, in terms of paid off loans, I mean, there has to be some triggering event of early termination. If it's a total loss, that would obviously be a scenario in the gap context, and that would be a total payoff. So I guess, yeah, in most cases, it would involve both the early termination of the credit facility, whether it's a lease, retail, or loan, and there would be some type of total payoff.
Thank you. Does state law follow where customer resides, where the dealer is, where the bank is, or where the product provider?
Well, I think we just went over that. It's really driven off where the customer resides, or the contract should be, if they know they're providing selling a gap waiver to a Kansas customer or Colorado customer, they need to comply with those state laws. And that could be separate and distinct from the governing law of the underlying retail installment sale contract, keeping in mind that these are two separate and distinct legal obligations as evidenced by two different forms of contracts.
Thank you. Is it likely that the CFPB will be more aggressive in enforcing consumer protections in 2021?
Kelly, do you want to take that one?
Sure. So we are anticipating that the CFPB will be more aggressive because of the new administration in 2021.
It hasn't been finalized, but if there is a change in the CFPB director, that will obviously have effect. But with the new administration coming in, as Kelly said, it's more likely than not that we'll see a more aggressive posture for enforcement and potentially greater consumer protections. Everyone should be aware that Elizabeth Warren was the architect of the CFPB, and now with the new administration, everyone will have to watch how closely she'll be involved with the CFPB in calendar year 2021. Kelly, do you concur?
Yes.
Okay.
Yes, I do.
Thank you. Is it possible that we will eventually see a uniform federal law regulating refunds? Will this law override state laws?
Kelly, do you want to address that question?
Sure. I think that's a really interesting question. I mean, in an ideal world, we would have one succinct, uniform law to look to regarding refunds, but we don't anticipate seeing anything like that happening in the near future. For now, refunds are inherently state law issues.
But if such a law were passed, it would potentially override inconsistent state laws, right, Kelly?
Right, correct.
So you could have, again, as Kelly mentioned, if there was an ideal world, we had one federal law regulating gap refunds. States could still come in and overlay more restrictive versions, as we've seen, like we have the base Federal Truth in Lending Act, but then you have all the state variations with respect to retail installments, sales statutes, consumer leasing acts, uniform consumer credit codes.
Thank you. If a vehicle is repossessed, is a refund required?
Well, that's a good question. I mean, if the vehicle is repossessed, that doesn't necessarily mean that the contract is terminated. That customer may have rights of redemption under state law. So just to maybe extrapolate on that question, if a vehicle is repossessed and ultimately is never returned to the consumer and it results in a termination of the underlying obligation, whether it's a lease, retail installment sale, or loan, at that point, that's when you'd be looking at the refund of the finance, the ancillary products, rather.
Yeah, Ken, that would be to the remaining balance, correct? Not necessarily a refund back to the consumer.
Yeah, maybe a credit to the account. That's a good point, John. Yep. A credit to the account, because you're in the default scenario. They may never see the dollars in hand. It would be a credit to their, whatever loss was realized.
Can a lender or finance company only accept ancillary products from an approved list of providers?
Kelly, do you want to take that one?
I can take this. Sure. So they can, but there have been cases where courts have held that an entity can't just limit that list to their own company. But a lot of lenders and finance companies have an approved list, but it is based on criteria such as rating. Yeah.
Thank you. If a lender or finance company outsources the administration of refunds to a third-party servicer, is the lender or finance company still liable in the event the third-party servicer is not compliant with state law?
The bottom line answer is yes. And the law is relatively clear here that if you are a finance company and lender, if you decide to have a third-party servicer engage in the administration of refunds, you do have a duty of oversight to make sure that they are compliant with federal and state law. So that underscores the importance of having a sophisticated and compliant third-party servicer if you choose to go that route to administer your gap refunds. And again, that's something that we have seen. The CFPB in their examination module has that specific item, on their checklist, if you will. So, and that would, pertain to not only outsourcing gap servicing of gap refunds or other ancillary product refunds, but any type of initial third-party servicing or sub-servicing. The concept here is that you just can't wash your hands if you say, all right, I'm going to have this party take care of it. At the end of the day, you still bear the full responsibility in the event the party that you chose, which is basically you're establishing kind of a principal and agent relationship from a legal standpoint, that they are not compliant. So many of our clients are very much aware that undertaking that servicing or sub-servicing obligation, you want to have some very clear reps and warranties regarding compliance. You want to monitor that compliance, and you want to make sure that when this comes up in a regulatory exam, you're able to show federal and state regulators a documented trail of oversight, review, and compliance.
Thank you. What happens if a provider or administrator becomes insolvent?
Well, we touched upon that in our presentation regarding a national warranty company that this happened, 5 or 6 years ago. That could happen. It's an unfortunate occurrence, but if it's a service contract provider, chances are the consumer is going to be knocking on the dealer's door or knocking on the lender's door because they are the beneficiaries of that finance contract, if you will. Now, from a legal standpoint, you could end up challenging it, but I think from a customer service standpoint, from a market profile standpoint, what we have seen is dealers or lenders accommodate, if you will, the customer in those unusual situations, so they're not left holding the bag, that they will get the value that was bargained for at the outset of their finance or lease transaction.
Thank you. Where do you see automation efficiency?
I think that's a question for John.
Yeah. So we see those efficiencies really in the ability to take a lot of the manual portion of the process. So the communications between both the providers, the dealers, and the lenders, that's one potential opportunity for automation. The second one being the data collection at the time of origination, right? So that available, collecting that data early on upstream will allow you then to effectuate these cancellations much quicker at a lower cost. So storing the data, preparing the data so that if a cancellation due to an early termination for whichever event occurs, you can immediately trigger that event and kick off into an automation. So those are just a couple of areas where we see efficiencies that can be gained.
Thank you. Can a dealer modify the ancillary product at the point of sale?
Kelly, do you want to address that one?
Yeah, sure, I can. Yeah. So legally, they can modify up to the point of sale, but it's definitely a red flag if they're, creating addendums or crossing out language. That kind of situation definitely underscores the importance of looking at the contract and being aware of any modifications that have been made.
And I would think from a practical standpoint, the dealer should be in a position to control the level of modifications. And, if in the, unlikely event that those modifications occur on the underlying gap contract or vehicle service contract, that could ultimately be, caught at the purchasing desk. But yeah, unfortunately that, it can occur, and if it does occur, those modifications could be binding on the gap provider or the service contract provider or the credit life insurer.
Great, thank you. This concludes our Q&A. I just want to say thank you so much to John, Kenneth, and Kelly. Remember, the slides and recording of today's webinar will be available later this afternoon on APSA's website in the Webinar Resource Center. If you guys want to say any concluding remarks, feel free to.
Marcy, again, thanks for the opportunity to share some insights in this very important legal, regulatory, and business area for not only today, but for the near future for automotive finance.
Thank you so much.